Hey guys, welcome back to Market Signal. Tonight's video, we're going to focus on a little something different because honestly, over the last probably 48 hours or something just isn't adding up to me in the memory market within the sector overall. Because we know over the last couple of days, we have seen some of the best performing stocks in this market, the Fab Five. They have been hit with violent selling pressure. Not as much today as what we saw on Tuesday, but they didn't bounce back. They didn't recover today like I thought they would. We saw Micron fall by over 7% on Tuesday. It snapped its winning streak and it moved it out of, back below the $1,000 a share mark. SK Hynix tumbled by almost 10% in Seoul. And we saw the other members of the Fab Five, SanDisk, Western Digital, and Seagate. They all faced another wave of selling today. Not as heavy of a wave of selling as we saw on Tuesday, but they just didn't bounce back overall. I thought we would see a little more recovery. In fact, the stocks tried to recover. Micron at least tried to recover today, and I'll show you that in the candle pattern chart in a moment. But as you would expect, we heard the chorus from all of the bearish analysts talking about if AI spending has peaked, have the valuations tapped out, and is this cycle essentially at a top? And while the paper markets are pricing in a downturn, something very different is happening right now in the physical memory market. We see spot prices for DRAM and NAND, they are grinding higher. AI server deployments continue absorbing enormous amounts of HBM, DRAM, as well as enterprise NAND, and suppliers remain constrained just in how quickly they can add leading edge capacity. We're seeing Micron right now gain ground, significant market share in the enterprise NAND market. They actually moved into the third space and they jumped Kioxia in that market. And we also saw one of the biggest signals today is that SK Hynix committed nearly $29 billion to buy back and permanently cancel its own stock. So the financial markets and the physical supply chains are telling us two completely different stories right now. Tonight, we're going to break down all of the signals we see in the market, and we're going to determine which one of those stories should we as investors believe. But if you haven't done it already, make sure you hit like, make sure you subscribe to the channel. Guys, I want you to be part of Market Signal, so if you value these videos, just make sure you hit subscribe now. All right, let's jump over and take a look at what we actually saw today. First, I just want to start off with what Micron did today. And like I said, it wasn't as violent today as it was yesterday. It was down by 0.37, $3.46. You see in the after hours, actually all of the memory stocks are trying to recover right now. It's up by $10.42, a little over 1%. It's trading at about $9.47 a share. And if you look over to the right, you can see SanDisk is up in the after hours, Western Digital's up in the after hours, as well as Seagate down below, up about 1.36%. But as I mentioned earlier, it tried to rally today. Take a look at the gap up that we saw immediately opening the day. The stock rose up to a high of 960, but then it just collapsed. It just didn't hold that momentum overall. Came back and it tried to rally again. We saw a little bit of collapse. Ultimately, rallied up again here about midday, got up to a high of 940. Stayed at that level for a bit and then just kind of collapsed as well again. And then once again, rallied back up to about the here closed this candle at 936, essentially where it finished the day. It finished at 937 overall. After hours, we're seeing a little bit closer to the 950. But I want to start out with a little bit of the bearish thesis that we're seeing in the market right now, because I think there's three like fundamental reasons why we're seeing the selling that we saw yesterday and saw it continue today, or just not as strong, but it just didn't bounce back. And I don't think what we're seeing is irrational at all. I think Wall Street is grappling with three distinct pressures. The first one, I'll scroll down here. You can see it in Micron. It's just, frankly, it's the parabolic run that these stocks have been on. We know the memory trade, all members of the Fab Five, most likely it was the Fab Four because SK Hynix came in later, but they all have experienced just unprecedented multi-100% runs. Take a look at the 6 months and the 1 year here for Micron. I mean, over 1 year, we're about a 700% return. So when expectations reach perfection, like we see in the memory trade, stock prices, they do not require deteriorating fundamentals to decline. They merely need kind of fundamental growth to stop accelerating as fast as they did. So that's part of the reason we're seeing right now is just positioning and valuation, and everything so great is being built into the price overall. I think the second piece is, and I'll jump over to this article that came out on Wall Street Journal earlier this week, is just the concern around, can this spending continue? Will we continue to see this duration and this commitment from the hyperscalers? This article is actually pretty interesting on Wall Street Journal. It talked about big tech's AI spending is $3 trillion higher than it seems. It talks about the off the balance sheet spending. So the leases that haven't been started, the purchase commitments that are not on the balance sheets, and it's a significant amount of the commitment for the hyperscalers overall. But I think there is this growing fear of, if this slows down at all, if we see any of these hyperscalers kind of pull back on their CapEx assumptions, which have been definitely pushed to extreme high right now, and it's making many members of the financial community kind of a bit uncomfortable overall, just with the debt that we have. We saw today that the U.S. hit a 40 trillion debt. That is going to have an impact on the stocks as well. But if we start to see this kind of even slow a little bit, it'll have significant compression on the memory sector, on the tech sector overall, any stock that is related to the AI infrastructure build out. So I think this AI spending duration also is a component overall. And then the last piece is something we've been tracking. We talked about it a little bit yesterday. It's just the bond yields, but also the inflationary concerns. It's kind of it's a growing concern in the market. And the Fed released their minutes from their July meeting. And I think one piece that we saw in here is there is a growing contingent within the Fed of having actually raising the rates in September at their next meeting. So if we go through here, you can see the title says the Fed meetings reveal a growing support for rate hikes. Sorry. It says here that there's more officials in favor of raising rates than we've seen in the previous meeting in June. So the record of the Fed meeting released 3 weeks ago after its decision showed that several officials favored raising interest rates. In June, it was only a few, and now it's moved to several. So there's this sentiment that there's a growing kind of contingent within the Fed that actually wants to see the rates grow. We know there were 19 top Fed officials present at that meeting. 12 vote on policy decisions, but it wasn't disclosed how many several means or how big that contingent is within the group right now. We do know that officials who supported holding policy steady argued that information gathered between July and the Fed's next meeting in mid-September could provide more clarity and correspondingly reduce uncertainty about the inflation outlook. So that's the piece we just have to measure in the market between now and September. What does the market look like? And will we be in a position where the Fed feels like they have to increase the rates? And that will definitely have an impact on the tech stocks. It'll have an impact on the memory stocks. If there's any hope in here, I will give you these last two paragraphs. It says investors have lowered their expectations for a rate hike at the Fed's next meeting in mid-September after inflation data released following the July meeting came in soft. The market has lowered the chances of a September rate hike down to 56% from 82% right after the July meeting. And that's according to the Atlanta Fed's market probability tracker. So there's a little bit of hope in there, but I think this is also just a kind of a sentiment that is growing in the market that could be holding back some of the growth that we're seeing ultimately with the memory stocks. Because here's the key piece we have to remember. When those yields push higher, like they were 5.3, we're going to see concerns around just capital shifting out overall. Macro borrowing costs are raising across the board, and that has compression impact on the valuations for tech stocks, particularly memory stocks as well. And there's a distinction I think that all of us need to know for our portfolios and the stocks that we follow is that fundamental compression is not the same as multiple compression. And this distinction matters because investors often look at a falling stock price and they assume that either the market found something wrong with the stock or there's something fundamentally broken with the business. And that's not necessarily what's happening here. If the risk-free rate rises, the present value investors assign to earnings 3 to 4 years from now, they fall. And therefore, we can see earnings and earning estimates continue to move higher while the stock multiples move lower. Macro yield spikes can drive high beta stocks down 15% without a single dollar of underlying earnings power being destroyed. The stock market is adjusting the multiple it is willing to pay for future cash flows, even as current cash flows remain robust and strong in the sector. So that's something that could be happening right now. And while we're seeing Wall Street kind of focus on on the discount rates we see in the market, the physical memory market is sending a very different, robust message overall. Let me pull up one piece because I want to walk through this with you as well. And it takes a look at the spot prices that we have seen for not only DRAM, but also NAND. So according to the latest data that you see on your screen here from TrendForce, spot trading volumes for DRAM and NAND, they remain subdued because buyers and sellers are deadlocked over the price. Yet despite these low transactional volumes that we're seeing for DRAM and NAND, spot prices for mainstream DDR4 chips rose another almost 0.7%. And the 512 gigabit TLC NAND wafers, they climbed almost 0.4%. Let me show you that. You can see it here in the graph, right here on the right side, the DDR4. If we scroll down, we talks about how supply and demand remains subdued, but we're seeing prices edge higher, grind higher, as I mentioned earlier. And we're seeing the same thing both in DRAM and NAND. I'll show you the NAND prices right here. They jump up on the left side, 0.39 for the TLC, 512 gigabit overall. And this is an interesting piece for me because in a conventional cycle, weakening transactional volumes like we see here in this report at least would eventually be expected to pressure prices as suppliers compete to clear their inventory overall. But today, suppliers remain sufficiently disciplined that pricing continues to edge upward despite the lower volumes that we see in the market. And that is not a footprint of an oversupplied market. Demand elasticity is showing up at these elevated price levels, but memory fabricators have retained their pricing power in the market. So we're seeing low volume in addition to raising prices in the market, and that is a clear signal for us to follow. The question is, how long can these two variables and these two conditions in the market coexist? I don't think it can, actually, if you want my opinion. I think we will see a shift here. I think we will see kind of the fundamentals and what we're seeing in the physical memory market take over for the concerns that we're seeing just with stock prices overall. But we will see how things shake out in the weeks ahead. But I think the other piece that I want to jump over to is an article here in Barron's. It talks about Micron itself and just some of the shifts that we're seeing. So it says Micron gained memory market share. The stock is dropping anyway. So let's talk about that and go through some of this. And it's talking about the NAND market in particular overall. It says in this middle paragraph here, despite the decline, Micron's business looks healthy as it gains market share. There is no sign that the memory chip prices will do anything but continue to soar across both DRAM and NAND flash memory. In fact, the combined revenue of the top 5 publicly listed NAND memory brands rose by 77% in the second quarter from the previous quarter, and they rose to just about $69 billion, according to new data from TrendForce. Micron's share in this market, it rose to 15.1% in the second quarter. It went up from 13.9%, and it's actually now the third highest. It ranks 3 in the market overall. It actually took over Kioxia, and it's just behind Samsung and SK Hynix. And remember when I shared earlier that Micron's DRAM market share is closing in. It's at a 25% share. It's closing in on passing SK Hynix. Right now, it's also, they're making ground on SK Hynix as well in the NAND market. So Micron is doing so many good things in the market overall, but it is just showing you that they are driving demand. And this NAND market is particularly important for the memory makers because as we shift towards the agentic AI where models run kind of continuously and they have multi-step reasonable workflows, it changes the hardware memory requirements. Remember, GPUs require HBM for raw compute bandwidth. CPUs require DRAM for system operations. But agentic workflows, they require massive SSDs and enterprise NAND. I think the biggest signal that I want to call out is what I mentioned earlier around SK Hynix's commitment to a $29 billion kind of stock buyback and cancellations of their own share. This is, in my opinion, probably the most fundamental counter signal that we can see today around just the bearish signs in the market overall. And if I pull up this article for you that was published on DigiTimes, the article clearly says that SK Hynix is canceling record number of shares, signaling confidence in a long AI memory cycle. If we go through some of the details, SK Hynix's board approved a plan to repurchase and cancel almost $29 billion of its own shares, the the largest share buyback and cancellation ever taken by a company listed in South Korea. The buyback will run for about 3 months from August 20th, and it'll cover some 24 million shares or 3.3% of the float for the company right now. The board also moved to raise its shareholder return for the 2025 to 2027 program period from within 50% of the cumulative free cash flow to over 50%. It's to be delivered through buybacks and cancellations running in parallel with cash dividends. So what does it mean? The article says the scale of this story is what it means, because canceling this much stock signals confidence that the HBM cycle has further room to run. SK Hynix is effectively telling the world and telling the market that it views the AI memory earnings as structural rather than a spike. That pointed signal is at a moment when investors keep asking whether memory is at the top of the cycle, and it lands the same week that CXMT became China's most valuable listed company. So this like net cash position that SK Hynix has right now, due to the pricing power and the demand that they have for the products in the market, that's what makes this possible. So just think about this. SK Hynix can return capital aggressively at the same time that it funds its CapEx race in HBM and advanced DRAM. That just shows you the power overall, but it also, I think, it gives you the confidence that this is not a spike. They don't view this as a spike. They view this as a structural long-term market and a real shift. It should help us ask this question: is what management team, in this case SK Hynix, commits nearly $29 billion to permanently deleting its own shares if they believe the memory industry is months away from a structural collapse? So management's view of cash flow durability stands in stark contrast to the paper market volatility that we're seeing right now across the memory sector. Now, that's not proof that SK Hynix can't be wrong. Management teams, they misjudge cycles all the time. They can misjudge them as well, but capital allocation at this rate is a much harder signal than just an optimistic earnings call or a soundbite from an earnings call. This is clearly a much stronger signal and a much stronger commitment from the company overall. But we should keep our eyes. I mentioned CXMT, and there's clearly some competitive pressures out there in the market. So let's pay attention to that a little bit as well, because I saw this article earlier in the week from CXMT mentioning how their DDR5 reportedly tops 9,000 megatransfers per second on an AMD platform, and it's narrowing the performance gap with global leaders. The result marks a notable step up from late 2025, when CXMT announced that their DDR5 was capable of reaching 8,000 mega transfers per second overall. And they also are expanding their wafer capacity. If I go down here, you can see CMXT is actively expanding its manufacturing footprint. Deal site adds that the monthly capacity is expected to rise from 300,000 wafers currently to roughly 350,000 wafers by the end of this year. And they want to further expand that to 500,000 wafers by the end of 2028. And there's one other piece here. It's around the yield. So they said here that progress is also evident on the manufacturing. So CXMT's 17 nanometer DDR5 chips have achieved a 90% yield. The chips are produced on this 17 nanometer class process. Just keep in mind the other memory makers such as Micron, they are producing on a much more advanced 10 nanometer class process and rely on extreme ultraviolet lithography overall. So this was a key kind of competitive issue. And I think one thing we've got to first realize is that the benchmark that they hit, a benchmark number of 9,000 megatransfers per second, that overclocking, that cannot be confused with high-yield mass-produced server DRAM. But the structural threat for the sector here, we shouldn't just pass this away. This is real, and the reason it's real is because CXMT doesn't need to beat SK Hynix. They don't need to beat Micron and HBM4 to impact the market. If CXMT absorbs enough domestic Chinese supply or Chinese demand for conventional DDR4 and DDR5, it frees up global supply and alters the baseline market economics. So this capacity trajectory is probably the single most important supply variable for us to track in this sector over the next 18 months. And we also saw the other Chinese provider in the NAND market. They are advancing stories about their IPO as their shares hit 14% in the market overall. They haven't listed a date, but they clearly are stepping towards an IPO, just like CXMT did. So that will also put pressure on the NAND market. It'll put pressure on SanDisk. It'll put pressure on Micron and the other suppliers of the NAND market as well. So those are the signals that I saw today, and those are I think the areas where we're not seeing the signals align. There's definitely some confusion in the market. There's some, an opposing viewpoints, and that's why I put the thumbnail as who wins. So let me give you my conclusion. I put a couple graphics together to just talk about what we see today. This is the memory trade scorecard. Our stocks are fundamentals right. If we take a look at the equity prices, it's clearly bearish. There's heavy selling. We're seeing multiple compression. Today's selling wasn't as heavy as Tuesday, but we're down from where we were significantly for all members of the Fab Five. Market is pricing in risk, positioning, and valuation, and rate pressure. But if we look at DRAM and NAND pricing, it's bullish. Spot prices are still rising, even on low volumes. So suppliers still have pricing power. There's no sign of oversupply yet. The AI demand is still bullish. The AI server deployments remain strong. Hyperscalers are continuing to invest heavily in the infrastructure. Supplier capital application is bullish. We're seeing SK Hynix buy back and eliminate over 29 billion of their own shares in the market right now. So management is confident in the long-term cash flow. They're confident in the durability of this memory cycle moving forward. HBM co-design and backlogs. I didn't even talk about this, but this is another bullish sign. We're seeing SK Hynix actually hire talent right now in Silicon Valley and embed them with NVIDIA, with AMD, with Broadcom, so they can co-design their memory architecture from the beginning. I think we'll see the same thing with Micron and Samsung as well. This is a moving trend. What's great about it is they're stepping in right on day one to help build that architecture together. It'll also make it really hard for a competitive company to displace one of these big companies when they have built it together from day one. The China supply expansion, CXMT, this is a watch for sure. They're trying to get to 500,000 wafers by 2028. What impact will that have on the market? I'll add YMTC in here, the upcoming IPO, because I think that'll have an impact on stock prices. And then the rates and the valuation, it is bearish right now. Higher yields. We're seeing right now crowded semiconductor trade. So the higher discount rates, it equals lower multiples, more volatility. But the bottom line is the equity market has clearly changed, but the physical memory fundamentals, they've remained strong. The gap is wide right now, and this is the test that we have to see in the market overall. This is the test, I think, that the market is kind of testing itself. And now these signs right here, it doesn't mean that the stocks have to rebound tomorrow. We're seeing a little bit of a positive movement in the after hours. But this doesn't mean that Micron can't fall by another 10% tomorrow or later this week. If yields keep rising or if positioning continues to unwind, stock prices can disconnect from fundamentals for much longer than investors expect. But if you're asking me whether the evidence that we have tonight confirms that the memory supercycle has fundamentally broken, my answer is definitively no. So tonight's signal also for this video isn't me saying buy the dip or that the memory cycle is over, or that it isn't over. It's that the financial and the physical markets have diverged far enough that we have a measurable test in front of us as investors. It looks like there's a clear separation or a temporary separation between stock prices and the physical industry fundamentals. But the good news, or the comforting news, is that historically, this type of separation, it doesn't persist for long. We're going to see one of two things. We're either going to see the physical fundamentals start to deteriorate, and we'll see signs of that in the market, and that'll validate the falling stock prices, or we'll see that the equity valuations of these companies will eventually have to catch back up, and the stocks will start moving in a positive manner again. But let me know what side of the trade that you're on, and what you think. For my ultimate question I said in the beginning, where we see this clear separation and who wins essentially was the question. Are you more aligned with the fundamentals right now showing us that this market has room to run? Or are you kind of more fearful and have some anxiety that the falling stock prices may show us that we're at a top or we're at a peak of this cycle overall? Drop your comments below. Let me know your thoughts. And if you haven't done it already, make sure you hit like and subscribe to the channel. Guys, I'll see you in the next episode.